SCHD. SCHD is the Quentin Tarantino of ETFs. It's got a cult following. It's like a Pulp Fiction, right? So if you like SCHD and you find someone else that likes SCHD in a bar or something like that, by the end of the night, you're hugging it out, you're having fun, right? You guys are connecting on a level that other people are not. You like SCHD, they like SCHD, that's how it goes. But there's a lot of people who also just love investing in the S&P 500 index. They invest in VOO, they invest in SPY, right? And so these people have a good reason to do that too, because the people who have invested in the S&P 500 index over the long term and just dollar cost averaged in have made a lot of money. They've beaten most every other mutual fund out there, and it's been a great way to go. If you've done that over 20 years, 25 years, 30 years, you're going to do a great job. And there are people who just want to do that, and there are people who want to go with more of a SCHD type of ETF, and there are people who want to blend these together. But the question is, at the end of the day, what do we do? What should we do? And that's what we're going to try to figure out in this video. So there's a lot we got to talk about here. We got to talk about risk. We got to talk about expense ratios. We got to talk about price return versus total return versus whether or not you're going to distribute money out of this thing. You're going to reinvest your dividends, all these different things. There's a lot to go over. Now let's start and talk about the expense ratios of these funds. So first off, we have 0.0945 is the net expense ratio of SPY. All right, now let's say that that's the exact same ETF pretty much as VOO. They do the same thing. They should almost have the exact same return. And VOO charges 0.03%. So off the bat, why would you go with this one over this one? Let's talk about that in a second, why someone might choose one of these over the other. But then we have SCHD. SCHD 0.06% expense ratio. Also, honestly, not a lot of money. So if you're gonna look at 0.03%, differentiate that here, and if you have a problem with that, don't do that. It's not material. It's so small. Unless you have $1 billion to invest, it's so small, it doesn't matter. So essentially, don't worry about these different expense ratios right here. Let's just call them the same. You don't have to worry about expense ratios on these two different ETFs when you're comparing them. But when you're comparing SPY and the VOO, you might want to think about that, because if you're getting the exact same thing for VOO as you are in SPYD, why in the world would you want to spend any more money, right? So that's a question for you to answer. But I will tell you, one of the reasons that this likely does happen, that people do invest in SPY over VOO, it does happen to do with liquidity. And this is not something that we really need to focus on, but I think it's interesting, so I might as well tell you. Okay, so liquidity is how much, let's say, volume is going through these ETFs, and when you have a lot of volume, you may have a smaller bid-ask spread, right? So here in this ETF and SPY, you have volume, just say in today's volume, it shows 56 million. Now over here in VOO, it's only 2.8 million. So it's a much smaller volume that's being traded here. And so, of course, if you want a tighter bid-ask spread, if you go over here, you can see the spread, 0.07 versus 0.096, okay? So 96 cents versus 7 cents. Okay, big difference, right? 96 cents, 7 cents, big difference in spread. So yes, SPY spread is smaller. If you're trading millions of dollars, if you are an institutional investor who works at a hedge fund, if you have a giant book of business and you are buying and selling money inside an ETF, you want to have liquidity because it does end up adding up. And of course, you're going to go with SPY. But that's probably the only reason. If you don't have millions of dollars to trade, don't go with SPY. Go with VOO because you're getting a lower expense ratio for the same thing essentially. Okay, so that's out of the way. Let's talk about VOO now versus SCHD, because we don't think SPY is very good unless you are a hedge fund manager watching this, which, hey, why are you watching my video? If you're a hedge fund manager, you probably know much more than I do. So VOO on the distribution yield, 1.49%, and then SCHD at 3.26%. So this is where we start distinguishing these two ETFs. SCHD having just such a high distribution yield comparatively to the overall market. Now, the market's good, 1.49%. That's pretty decent. But this has a much higher distribution yield. Now, we need to decide, okay, what do we care about? What do you care about as an investor? Do you care about distribution yield, or do you care about return, total return? Because if you're reinvesting this money back into your portfolio, then I don't know if you should even care about this 3.26%. Really what you care about is how these have done, let's say looking backwards, which one has outperformed if you reinvested the money and went into the future, right? That's what we're kind of trying to figure out. Now, if you do care about taking money out of this thing as dividends, you don't want to sell shares, you just want distributions, and you want to live on those for whatever reason. Maybe you're retired, maybe you're financially independent and you're retiring early or whatever it is. If you want to get distributions from your ETFs without selling anything, then okay, this might be a good way to go. So to figure this out, let's go ahead, let's run the numbers and see how this looks. So we have the Spider S&P 500 Trust, that's SPY. We almost don't need to look at it, but we're going to keep it in here just because there is some interesting stuff. We have VOO here, Vanguard S&P 500 ETF, and the Schwab US Dividend Equity ETF. So, okay, final balance of investing $10,000 over 10 years, you get this. You get about $40,000 in Vanguard. You get about $39,000 in Schwab. So, okay, very close. Not too big of a difference, but you did definitely get a better compound annual growth rate in Vanguard than you did in Schwab. 14.08, 13.72. You know, you kind of go over another 10, 15, 20, 30 years, and it might add up to, you know, a little bit extra money that might be significant. So, yes, you probably have done better if you had invested inside the S&P 500. These are assuming you're reinvesting your dividends, right? If you look at this and you don't like put the dividends reinvested in there, but just say you took the distributions out, then it's going to look a lot different, because if you take all of the 3% out and you don't reinvest it, then SCHD is not going to look as good as it is here. Of course, we want to talk about risk because we want to see, is SCHD really a lot less risky than the S&P 500? And if it is, then that's obviously something you want to consider. If you don't like price volatility, then you don't want to have it, especially if you can get a good return maybe and still not have the price volatility. So is SCHD a volatile ETF, comparatively speaking? Let's take a look. So the worst year for SCHD was actually a negative 6.39%. Okay, that's good, but that's not the worst drawdown. That's the worst year, right? So let's get the max drawdown. Actually, the worst drawdown was higher in SCHD, which actually is not good, right? So you have some volatility in this ETF. It's not a non-volatile ETF. It's not like it's only losing like 6% when the market goes down 20. It's actually losing a lot of money if the market does fall a lot. Now, Vanguard's VOO down 19.95%. So actually, SCHD was down more in the largest max drawdown here. So that's not necessarily a good thing if you're price sensitive, or if you're really looking for something that's not going to give you a lot of volatility. There is some volatility in SCHD. In terms of market correlation, let's say beta, so what's going on here? Well, of course, VOO and they're correlated to the market. They are the stock market because that's what we benchmark this against. So they have a 1 as a beta, as a correlation, and then 0.92 is SCHD. So it's less correlated to the S&P 500. So there is a bit of this difference between price returns and what happens when the market goes up. SCHD might not go up as much, or it might go down, and vice versa. So there's a little bit of difference in correlation there. Now, if we take a look at portfolio growth, we can see here is what we're looking at, what we want to know, and this is over from 2012 up until this year, at this time period during the year of 2022. What do we have? Well, we have we have the numbers right here, basically, is what's showing you. So you can see here, they're pretty much very similar, and yes, SCHD has lagged by a very small amount. But let's look at the annual returns and see in certain years what happened during this time period. This really helps you visualize, in my opinion, how this looks. So if you take a look, the main thing you want to see is that this orange one is SCHD. So the orange one, SCHD, it underperformed in 2021. It overperformed slightly in 2013. I said 2021, I meant to say 2012. It underperformed in 2014, underperformed in 2015, overperformed in 2016, under, over so far for the over for the year so far in 2022. Okay, so what's this kind of telling me? Main things are, first off, it doesn't necessarily mean it does better in a bear market. Honestly, does it? It lost worse in 2018. The S&P 500, or VOO, let's call it, lost 4.5%. SCHD lost 5.56%. It doesn't necessarily matter if it's a bear market or a bull market sometimes. Looking at the past, for the returns of SCHD. A lot of people think just fact that it's a bear market, maybe things aren't doing as well, SCHD is not going to do as bad as the S&P 500. Not true. At least in the past, it has happened that SPY has done better than SCHD in a down market. Same here. We had a pretty flat market 2015. SCHD, it actually had negative 0.31% return, 1.25% for SPY, right? So, all right. To date, though, we have done a lot better in SCHD than we have in SPY or VOO. And of course, we have portfolio income, and that's something that if you're an income investor, if you want those distributions, you're going to really want to watch this part because you have so much more in distributions and yield from this than you do from SPY or VOO. And as you can see here, of course, over time, at this time period, let's say in 2022, so far you've had $632 in distributions, whereas the other two only have just under $300 in distributions, right? And then if you look at 2021's total distributions, it's over twice the amount, $1,138. This is if you had $10,000, $1,138 versus $570. So of course, a lot better distributions coming off of SCHD than in SPY and VOO. So again, if you're like a person who's like my age, like someone like me, I'm trying to invest for the long term. Guess what? I base me beating the market on beating the S&P 500. So I'm trying to beat the S&P 500. So I'm not necessarily just investing in it. Now, I have some SCHD in my portfolio. So I do like this ETF. I have some of it. But that doesn't mean that I think this is going to necessarily outperform the market. It's kind of like just a portion of my portfolio, a smaller portion that I'm having in there to kind of like help out if I am wrong in a certain year, which as we can see, there are some years where SCHD does better, right? So we have here, right here, boom, 2021 SCHD did better, 2013 SCHD did better, 2016 SCHD did better. So there are years where it does better. Over time, I don't think it's going to necessarily outperform the S&P 500. If I reinvest my dividends into the ETF, I don't think it's going to necessarily happen. Let me also point out real quick that you do see that Vanguard's VOO did outperform SPY over that 10-year period of time, 14.08 versus 14.02. Why? Probably because of the expense ratio, right? SPY is a little bit more expensive than VOO. I want to talk about exposures, then I just want to show you what happens if you actually distribute money out of this thing going forward. So exposure-wise, we're going to see that, of course, you're going to get more of a blend inside the S&P 500 type of ETFs. The VOO, the SPY, you're going to have a blend of large cap value, large cap growth. They're going to be larger companies because they're the largest companies in the stock market that are inside the S&P 500, which is VOO, SPY. Now, if you look over here, though, you're going to see that it's mostly large cap value. 84.74% are going to be in large cap value and only 9% in large cap growth. What happens when value does better than growth? You're going to do probably better here, even though what's interesting is growth has done a lot better than value up until recently, but still SCHD has outperformed. So SCHD does do a very good job at picking good stocks that might even be value stocks that are large cap, but still have done better than the general value segment of the market. And that's probably due to how they're picking the stocks and the different methodology they're using to find these companies. Okay, so the last thing I want to do is I want to say, what if I'm taking money out of these ETFs going forward into time? How do these look? Like, does it actually affect the rate of return a lot between the different ETFs? So I said, okay, I have $500,000. I'm going to invest in these. I haven't invested. I'm taking out 1.5% every quarter. So that's about 6% for the year. And then that's what I'm doing, and I'm rebalancing annually, which that doesn't matter for this. And so what happens? I'm also reinvesting the dividends, by the way. So dividends are going back in, but I'm taking distributions out. Okay, so what happens? So portfolio 3 is SCHD, and what we have here is $500,000, ends up final balance being $133,000. So you do have quite a bit less money in this situation than if you had money in the S&P 500, right? So CAGR here is 7.44% versus 7.10%. Again, but if you look at the difference in actual money that you have, $30-something thousand difference, to me that it ends up being beneficial, right? So over time, if you do take money out of these ETFs, if you keep it invested, you put it into VOO or you put it into SCHD, and you keep it going forward and you take out 6% every year and you do it in quarterly amounts, you're still going to have a lot more money probably in SPY. Not a lot of money, but $30,000 to me is a decent chunk of money over 10 years. So you mix this in with the fact that there was a market drawdown of more in SCHD than there was in the S&P 500. And actually, I do definitely think for me, if I was going to just decide on one of these two, I would go with VOO. Of course, because VOO is going to be better than SPY. At the same time, if you look at it, it's really done a better job than SCHD has with large amounts of money, of course, but still, definitely $30,000 in the future while taking out money from it. To me, I mean, it looks better. And this is coming from a guy who does have money in SCHD as well. So anyway, that's all I have for this video. I hope you like it. Let me know in the comments. If you want to watch another video, please watch it on the end screen right now.